stock pays you in dollars, another in euros, another in pounds. Different countries, different currencies, different economies. But the income keeps coming. This isn't just dividend investing. This is global dividend investing. And for many long-term investors, it's become one of the most powerful ways to build strong cash flow through changing market cycles. Most investors start with what they know: their home market, their local currency, companies from their home countries. Why, you may ask? Because it seems familiar, comfortable, predictable. But over time, concentration becomes a risk. Economies behave differently. Inflation varies from country to country. Central banks are on different interest rate cycles, and currencies can shift dramatically over long periods. A portfolio that is tied entirely to one market is exposed to the shifts of a single economy, be it positive or negative. That is why experienced investors tend to think in globally, not because they are chasing complexity, but because they understand one simple principle: the world does not grow evenly. While one economy slows down, another may pick up. While one currency weakens, another may strengthen. Global dividend investing is not just about generating income. It is about building resilience into the portfolio itself. Generally, the best global dividend portfolios feature three pillars: stable companies, diversified currency exposure, and consistent long-term cash flow. And the basis almost always begins with quality businesses. Think about companies like Coca-Cola, Johnson & Johnson, Procter & Gamble, Nestlé, or Unilever. These are not companies built on hype cycles or short-term buzz. They sell products that are used by millions of people every single day in multiple countries. What makes these companies powerful for dividend investors is not just the dividend itself, it is consistency. Some of these global companies have continued to pay and even increase their dividends even through tough times like recessions, inflation shocks, financial crises, and even large-scale pandemics. Markets have evolved, governments have changed hands, but that didn't stop the cash flow. And this is usually the part that new investors often misunderstand when it comes to dividend investing. The goal is not to find the highest yield possible. In fact, high yield can sometimes be a red alert. If a stock price crashes, then the dividend yield may suddenly start looking very attractive. But that yield may not be sustainable at all in the long term. Here's what separates new investors from experienced ones. Experienced ones always dig deeper. Look at the bigger picture. They look for stability in the earnings, cash flow generation, debt levels, and the payout ratio. Because imagine a company that can steadily pay dividends for over 30 years. That company will automatically be far more valuable than a company paying an unusually high amount for a short time. Then comes another layer that global investors cannot ignore: currency exposure. Your returns are not just affected by how your stocks are performing, they are also majorly affected by exchange rates. Here's a simple example. Imagine a US company increases its dividend by 8%. On paper, that sounds positive. But if your local currency strengthens sharply against the US dollar, your actual income after conversion may barely grow at all. In some cases, it may even decline. Do remember that currency exchange rates depend on multiple factors simultaneously. This is exactly why experienced global investors diversify currencies along with their stocks. A portfolio concentrated entirely in one currency carries hidden risks. If that currency weakens significantly over time, purchasing power can also weaken, even if your portfolio income appears stable. The impact may not be immediate, but purchasing power can erode over time when you look at it long term. When you hold dividend-paying assets across multiple countries or regions, you create exposure to different economic systems and currencies. The US dollar may strengthen during one phase. The Swiss franc may become defensive during another. Asian currencies may behave differently depending on trade cycles and regional growth. Over long time horizons, this diversification can help smooth portfolio behavior. That way, even if one currency weakens, another might make up for it. The US is one of the biggest dividend markets in the world, particularly for companies with long dividend histories. Most of the world's largest dividend-paying businesses are listed in the US stock market. They range from consumer goods and healthcare to industrials and even energy. The United Kingdom is another big market for dividend investors. UK companies have generally distributed a higher proportion of earnings via dividends, especially in banking, telecom, and energy. European markets, and particularly Switzerland, possess world-leading defensive companies with internationally established, stable revenue streams. Investors also consider Canada and Australia, where banking, commodities, and infrastructure have historically dominated dividend investing. Finally, there is Singapore, which has increasingly catered to income-focused investors, and especially through REIT structures. But the most underestimated force in dividend investing is not the dividend itself, it is reinvestment. Use dividends to buy more shares, then let those shares generate more dividends, and repeat the process over and over again. Initially, the impact may feel small, but over long periods, the money will compound and will keep accelerating quietly in the background. This is why many long-term investors automatically reinvest dividends instead of withdrawing them early, because the more time you give to it, the better the compounding effect takes place. And that is the absolute heart of global dividend investing. It is about controlling your emotions. It is not about chasing the highest yield you see on the screen. It is about building a system that can continue to generate income through different environments, different currencies, and different economic cycles. Because markets change, governments change, interest rates change, entire industries rise and fall, but strong businesses with durable cash flows and disciplined capital allocation tend to endure over time. In the end, a global dividend portfolio is not just a collection of stocks scattered across countries. It is a framework, a system built around resilience, diversification, and long-term income generation. One designed not just to survive uncertainty, but to keep working through it. Explore global markets and track dividend-paying stocks worldwide on the Dealing.com app. If you want to know more about global investments, download the Dealing app and subscribe to our channel.